Hello everybody, Datalist Investments here. Today we are going to discuss a company called CN Rail. And this is going to be our second video in a series of videos where we essentially just analyze certain companies and provide a conviction on them based on analysis that we do in the video. So, one thing that is going to differ from this video, from the last one, is I'm going to focus a lot less on just the numbers of the stock and focus more on familiarizing myself with the business and the industry and how the company actually sees itself fitting into the industry as well. So the structure of this video is just going to go like this. We're going to analyze the railroad industry first, and then we're going to go into a deeper dive on CN Rail. And just as a closing thought, we're going to look at the merger between CN Rail and Kansas City Southern and see what the implications are for the future of the company. So without further ado, let's just get right into it. Basically, the railroad industry overall has always been a really efficient way to get goods from point A to point B. And a lot of stock gurus, mainly Warren Buffett and Bill Gates, have always been really big proponents of the railroad industry. Um, in 2009, Warren Buffett acquired Burlington Northern Santa Fe and added it to his portfolio in Berkshire Hathaway because he strongly believes that the freight rail system in America is essentially a bet on America because that's how most goods get from one point to another. So that's really good, and that's definitely a big supporter of the industry. We also have Bill Gates, who also is not as prolific as Warren Buffett in terms of his support of the railroad industry, but CN Rail is actually his fourth most owned stock in his portfolio, so that's pretty interesting too. Now, before really kind of getting into CN Rail as a company, I think it's important to recognize what makes the railroad industry so unique. And the main reason that I think that the railroad industry remains to this day one of the most profitable industries is because of what's known as a moat. A moat is a term that's used to describe how difficult it is for a company to enter an industry. If an industry has high moat, that means there's high barriers to entry and competition is pretty much not very likely to enter the industry. But on the other hand, if there's a low moat, that means it's easy for competition to enter the industry, and there could be a lot of competition later. So I think this map is what we need to familiarize ourselves first in order to really get a feel of what the railroad industry is like. Um, so just to see where everybody starts owning certain railroad routes, we see that the western United States is dominated mainly by Union Pacific and overlapping with BNSF Rail. As we go to the Midwest United States, we actually see that CN Rail is what is dominating most there, and that's because of an acquisition that the company made of an American railroad a few years ago. And so as we go down to the southern Midwest United States and into Mexico, we see that Kansas City Southern is actually the sole competitor in Mexico. So a lot of really good potential there, and we'll touch on that later in the video as we discuss the merger between the two. If we go to the eastern United States, we see that CSX and Norfolk Southern pretty much share a massive overlapping with a lot of concentration within the big cities. And as we go up to Canada, we see that CP Rail, Canadian Pacific, is dominating the west with some overlapping with CN. And in the eastern Canadian provinces, we see that CN Rail is pretty much the sole dominator. So, just going back to the discussion of the moat, what I think I want you guys to realize is that this extensive route, this extensive network of railroad routes makes it essentially impossible for a competitor to just come and show up and say, I'm going to build a new railroad and a train track. Because if they decide to do that, these big monolith companies are essentially just going to swallow them up. It's going to be pretty much impossible for any new company that's trying to enter this industry to turn a profit. And I think that's what really makes this industry unique, is that it's so dominated by these class 1 railroads that it's just impossible for competition to enter. And also, what I think you guys need to also realize is that these railroad routes didn't just pop out of nowhere. Most of these companies have been around for many, many years, and their current railroad network is a culmination of more than 50 plus years of hard work. And so I think that basically, if another company was to, hypothetically open up a railroad in the middle of wherever, it would be an economic disaster because they would have to get not only like they need to get regulatory approval because you can't just lay down a track anywhere, but they would also need to compete with these people who have been around for so long and have built their network over many years. So again, what makes this industry so special is how long it's actually been a thing, and essentially just how big the moat is. So, just to get a small history lesson, the entire history of railroads started with Abraham Lincoln signing the Union Pacific Charter during the cusp of the Civil War. And that's what basically started the Union Pacific Railway, which is the first railroad in all of North America. And we see that it was founded in 1862, but is still publicly traded today on the stock exchanges. So just looking at that kind of tells you the magnitude of how long these people, I mean these railroads have been there, and again, what makes it so unique and why it's so difficult to enter the industry. So another thing that I think really separates the railroad industry specifically over from other forms of transport is how efficient it is at getting goods from one place to another. This infographic by the American Association of Railroads tells us that on average, freight trains can move 1 ton of freight 480 miles on just 1 gallon of fuel. Now, if we take another less efficient mode of transportation, for example, trucking, they can actually only move 1 ton of freight 134 miles on just 1 gallon of fuel. So just purely from a fuel efficiency standpoint, railroads knocks it out of the park, and definitely is much better than trucking at transporting goods from one place to another. Another thing that really helps with railroads is that they actually only account for 1% of global CO2 emissions, while other forms of transport like airlines, trucking, shipping, and even roads, even just normal passenger freight, accounts for much more than railroads do. And I think that's mainly just because of highway congestion and the fact that railroads don't really have to deal with that stuff. So now that we've kind of analyzed the railroad industry as a whole, I think that it's time that we kind of jump into Canadian National Railway and what makes it a good company and how they fit into the railroad industry. So at a glance here, we can see that as of July 16th, 2021, CN Rail is trading at $105.75 a share, placing it right at about the 10% mark or so below its 52-week high. We can see that the market cap of the stock is $74.45 billion, which places it comfortably at the classification of a large cap stock. We also see that it is trading at a 26 times earnings multiple, which I just want to say beforehand that this is something that this is a little higher than what I'm normally looking for. But that being said, PE ratio is really subjective, and depending on if the other parts of the analysis confirm your conviction on the stock for a long, then P ratio is something that can definitely be flexible. Lastly, we see that the company does pay a 1.92% dividend yield to shareholders, so that's definitely a pretty good thing for the long-term investors out there. So I kind of wanted to combine the aspects of fundamental analysis that I did on the other video into just really one big comprehensive segment to kind of analyze CN Rail. I'm still going to use the score method to kind of look at how strong a company's financial balance sheets are, because I think that scores, again, are a really good comprehensive way to combine multiple aspects of the balance sheets and still see in an easy-to-use manner whether or not they're strong. And we can say that from this that the Piotrowski F score and the Altman Z score are both in the safe zones. They're not in the safest zones, but they're safe enough. From a revenue growth standpoint, we can see that the revenue has been growing over the past 5 years, with obviously the exception of the COVID-19 pandemic. They were hit pretty hard. But that being said, there was really good growth right outside of the pandemic, and I think there will continue to be really good growth, especially because of their merger with Kansas City Southern. I think there's a lot of potential to be had there. Just in terms of raw profitability metrics, we see that that Canadian National's operating margin is 41.63%, with the net margin being 25.53%. These are both really high numbers, and they're much higher and much better than the industry average, and this industry being transportation, not railroads. Most of the railroads across the board will have similar metrics to this because essentially, like I talked about before, most of the railroads operate in duopolies, in each region of North America. There's normally two railroads that really dominate the whole scape. And when they do that, they can basically become price controllers. And as a result, they can be really, really profitable when they want to. So that's really good. Um, we also see that the return on equity and the return on assets is 18 and 7% respectively. Again, much higher than the transportation industry average, and a really good sign for profits in the long term. Last thing that I want to kind of touch upon was something called free cash flow yield. This is just another metric to find how solvent a company is, and it's taken by dividing the free cash flow of the company by the enterprise value, which is just a kind of modified version of market cap. I think it just kind of includes debts and stuff like that. So when we do that, the free cash flow yield, when we do that calculation, the free cash flow yield is about 4%. Which is average for most stocks out there, but is a little bit higher than most of the Class 1 railroads. So we see that probably CN Rail has a pretty good competitive advantage there. Now, the main reason that these railroads to this day remain super profitable is because of something called precision scheduled railroading, which all Class 1 railroads except BNSF Railway operate under. And in the eyes of these freight train companies, it's basically just a way to leverage technology and leverage efficiency over just quantity of goods transported. And so basically by implementing PSR, they follow a strict regimen, a strict schedule that leaves at a certain time rather than waiting for cars to be piled up on them and transporting all of that to another place. Basically by operating on a standardized time schedule, they're able to increase velocity, they're able to decrease the terminal dwell time, increase fuel efficiency, have longer cars, and have more cars transported just because they're making more trips more frequently. And of course, it enables more profits for each of the companies. Now, PSR has been really, really good for the most part for executives and people who hold shares of the company. But we're going to just talk about in a little bit here the risks, the amount of risks that associate with PSR, and why that kind of funnels into other investment risks for the company. So the main risk with PSR and these profit first initiatives is just safety. The railroad industry has always been a really safe industry, but when things go awry, it's really, really bad for the whole industry, and there's not a lot of wiggle room in terms of accidents that could be neglected because almost 99% of hazardous materials, including molten asphalt and molten sulfur, are transported across rail throughout the country. And so the fact that there are derailments is devastating. In 2019 alone, railroads reported 341 derailments, and that's just really bad because the damage that can amount from just one derailment is almost insurmountable. And executives of these companies have largely downplayed the risk of these derailments, but eventually we'll see that this can't be the sentiment that's reflected forever because the trend is overwhelmingly seeing an uptrend, and it's really important that these CEOs and these leaders of these freight train networks make sure that safety is their number one priority. Now, another kind of indirect risk and an indirect thing that has come out of PSR is obviously terminal dwell times being lower. But what these terminal dwell times being lower has done, which actually seems like a good thing in the first place, right? But if you notice it further, what these lower dwell times have done is basically kind of lowered the amount of time for inspections on the train and the tracks, and this makes every single freight rail a lot more prone to accidents and a lot more prone to bad things happening to them. Another kind of small thing that I wanted to discuss is the prospect of regulating the industry. Like I said before, they're duopolies, so it's only a matter of time before somebody starts cracking down on them, but I wouldn't worry too much because they're still probably going to remain pretty profitable, and that'll still be fine. Now, this concept of digitized scheduled railroading is something that's specific to CN Rail and unique to CN Rail, and how they're actually transforming the narrative when it comes to precision scheduled railroading. Now, in this, they're basically, all they're doing is kind of using technology even more in order to completely eliminate the human error aspect of anything that may cause accidents. And that means things like inspections, track inspections, conducting. Conductors will probably be entitled to use tablets and other things that may help them along their journey. So just by eliminating that, I think it'll definitely still be a step in the right direction in terms of safety. But more than what is the actual substance that's contained in here, I'm really much more happy with the fact that CN Rail's executives have found this safety hazard as an issue, and they've recognized that it needs immediate fixing, which a lot of the other freight rails have not. So I'm really optimistic in the sense that I think that CN Rail will lead the charge to make freight rails safer and make that derailment number go down in the future. So as this video sort of wraps up, I just wanted to discuss my thoughts on the CN Rail and KCS merger. CN Rail has offered to buy out Kansas City Southern for somewhere upwards of $30 billion, and it's going to be a conventional buyout of all the shareholders' equity. Taken from KCS's website directly, we see that each person who held KCS is going to be entitled to $200 in cash plus a little more than one share of CN Rail. And this obviously costs a little upward of $30 billion. And this deal is going to give CN Rail access to all of Mexico, which is there's so much untapped potential there. So I'm really happy with the takeover target. And I think that CN Rail, frankly, was the perfect partner for KCS, because we already see here that CN has a presence in the Midwest United States. So the transition between KCS and CN will probably be pretty seamless, and that's a really good thing. I believe that this deal actually makes CN Rail the largest Class 1 railroad operator in all of North America by area. And that's really cool, because I think it looks like they control 4 coasts now. One here, one down here, and obviously we've got Mexico. So they're really sprawling across the continent, and an investment in CN Rail will essentially be an investment in the largest railroad company in North America. So I'm really optimistic that the growth potential for Mexico and the amount of area that's sprawled by KCS and CN will make for a lot of good revenue in the future, and will hopefully help a lot of profit-making decisions. So as we kind of wrap it up here, the last thing that I wanted to discuss was some analyst price targets. Most of them here kind of reflect the same sentiment of the fact that CN Rail has upside, but it's kind of modest. It's limited upside, and I kind of agree to them. I agree with them to the sense that I don't think that this will net like 300-400% returns or anything, but I still think that railroads, and really any railroad that you just do decide to invest in, they're basically, I think, one of the best low risk, high reward type scenarios that this market really has to offer. And so despite them not being 300-400% gains, I think there will be really good gains in the future, and I think I can count on them. So I reflect wholly the sentiment that is there from the analysts, and I am a happy buyer of Canadian National Railway. And no matter what market condition it is in, I will still be probably funneling money into this company. So again, I'm really happy with the growth potential, and the fact that they are so big, and I think they'll make a really good investment. So that about wraps it up for the video today, guys. Thank you so much for tuning in to the end. I hope you all liked it. Even if you didn't find it useful in terms of an investment thesis perspective, I hope that you all found it useful from an investment education standpoint. If you did like the video, please consider liking this video and subscribing to the channel. Please take a look at all of our other social profiles. It really helps with our web presence and the algorithm as well. But thank you again. Until next time, guys, I will see you later.